Good morning, everybody, and welcome to this webinar on the topic of microinsurance, something that I've been looking forward to discuss for quite some time. I am a genuine believer that microinsurance is the next opportunity for the insurance industry. And I'm very pleased that today with us we have Richard Leftley, who is joining us from the UK. Richard is absolutely an expert on the topic, and I'm sure that he will be able to share some absolute insights over the course of the next hour. Richard, welcome. Thanks for taking the time this morning. I think it would be best actually if you introduce yourself, your merits, and tell us a little about your experiences with microinsurance across the world, please.
Sure, I'd be delighted to. Firstly, thank you for having me. Great to be with you today. My name is Richard Leftley. I'm based here in the UK. I started off my career as a reinsurance broker in the mid-90s in London. And by the end of the 2000s, by about 2001, I became absolutely fascinated by why it was that people in emerging markets, so Africa, Asia, Latin America, seemingly didn't seem to buy insurance. If you looked at the statistics, about 98% of the population didn't buy insurance. And yet, this was the height of the HIV pandemic. There were, the same number of natural disasters, happening as there are today. And as a result, the risks were real. These people faced enormous risks. And in many times, they didn't have either a private, an insurance safety net or a public sector safety net that would stop them slipping back into poverty. And so end of 2001, beginning 2002, I started to try and do something about that. I created a company called Microinsure, which was one of the first insurtechs, 3 years before Facebook got created. So perhaps a little bit early to the party, but nonetheless, we went on to serve more than 60 million people in 12 countries. That was really interesting experience, learned a lot, and I'm going to share some of that with you today. And then went on to co-found a reinsurance company called MIC Global in 2020, which is now a Lloyd's syndicate. And then more recently have turned my attention to how to grow the next generation of insurtechs and innovative insurance solutions.
Fantastic. Well, thanks a lot, Richard. My name, as most of you joining today might know, I'm Niels Trzecieski. I'm the Global Head of Sales for IBA. Part of my job is actually to participate in discussions like this with Richard and other industry analysts, industry people with the insight in the industry, and in order to identify trends and directions, and then see if we can somehow, using technology, translate that into opportunities for insurance companies. And this conversation that we're having today is actually an extension of a conversation that Richard and I started 2 years ago, or actually 1 year ago, at the InsurTech Insight conference in London, where we also had a panel debate on microinsurance. And that certainly sparked some interest and some thoughts on my side that I would like to bounce with you today, Richard. So hopefully we will have an opportunity to dive into that today. And also we'll be taking questions from the participants, the audience of this session that has an opportunity to post their questions in the chat session, and we'll be taking a look at that a bit later in today's session. And we have about an hour together, so I'm sure we'll have time enough to cover both the topics that we would like to dive into, but also some questions from the audience. So Richard, a place I would like to start is really that microinsurance, as you mentioned, has its origin in the developing economies, so in Africa and Asia. But certainly there's kind of two aspects to this. One aspect is the responsibility in society to help the people in need, the low-income people who have the need of protection. But the other aspects, of course, is the insurance companies who have a responsibility to the investors to make sure that this is actually something and a service that they can supply in a responsible way. So how do you find that balance? And using your experience from, again, these developing economies, what was the point of view from the insurance companies in engaging in this?
Yeah, actually, it's interesting because I remember, that was actually my first question, if I'm being honest, Niels, right? Okay, so, it's evident from the statistics that these people aren't buying insurance. Now, is that because, so is it a supply side issue or is it a demand side issue? Is it because they don't want the insurance, or is it because the insurers aren't willing to supply it? And certainly back in 2002, when I started, 21 years ago, it was a bit of both. So, certainly there was a kind of a real reluctance from the insurance companies. Interestingly, when I first, was speaking to the insurance companies, many of which, of course, were my clients because I was their reinsurance broker. So I was dealing with their kind of, executive team and saying, kind of, tell me about your portfolio. And it would be, okay, so our existing portfolio is, executives, motor insurance, bank assurance. And it was very much a model that had kind of been airlifted from Europe into Africa, and into Asia. And so then my next question was, well, why don't you serve, the middle income market or the low income market, which makes up the majority of the population in your countries? And there was this kind of like sharp intake of breath in the insurance companies, and there was this kind of perception that wasn't possible, right? That it was just, that these people were really high risk, that they would, there would be a lot of fraud. There was just a real concern that they couldn't do that. At the same time, the products which they were offering just weren't really that user friendly, right? They were really hard to understand. There was, a lot of wording. There was a lot of clauses. There was a lot of friction in terms of signing up. I mean, if you wanted to buy one of those policies, you had to visit an office, fill out a paper form, and then provide some kind of proof of identification, and then pay the premium for the whole year in advance. And if you think about that, for a low-income person who can't really read, doesn't know how to write, doesn't have any ID, doesn't have a lump sum of cash, doesn't have transport, can't get to the office. I mean, the barriers, the friction involved in understanding and buying insurance was massive. And so, the first thing that I did was to work both with the insurers and also with the customers, and to find out kind of what needed to be done. And of course, the answer was to massively simplify the insurance products. So we ended up kind of I just kept asking insurance companies, like, why do we need this clause? Why do we need this clause? Why do we? And eventually we got it down to a policy which was very simple. I mean, initially it was just one sheet of paper, and eventually we did actually get a policy that was just one text message, so 160 characters long. And you can do that. It is possible. And then, we started to remove friction from the customer journey. So instead of having to fill out a paper form, you just had to send in a text message. And instead of paying your premium in one go, you could pay premium like on a daily, tiny little amount of, kind of a tiny amount deducted from your mobile phone. So, when you started to do this and you remove friction from, you made a simple policy and you remove friction, we started to see large numbers of people sign up. In fact, one of the telcos that we worked with in India, we signed up 20 million customers in just 140 days onto a voluntary insurance product. So I think it was the quickest growing financial product anywhere in the world. In fact, I think it's still in the Guinness Book of Records for that reason.
So I'm a firm believer that there is some insights, there's some experience gained by engaging in those markets that can be, as you mentioned, that originally the insurance products was airlifted from Europe to Africa and Asia, but I think there's an opportunity now to take the insights back to Europe and the industrial world with high insurance penetration, and see if there's some learnings from these environments that you can apply in your high penetration, high education type environments.
Yeah, I think there are two main areas that we're seeing that. So the first thing that I think we learned in microinsurance was that, and I think that the insurance companies have actually learned this. It took them quite a long time to learn it, but I think they have now learned it, which is that it's very, very hard to do this kind of level of innovation. So, microinsurance is innovation, right? It's like turning, it's breaking some of the rules. And to do that within the existing structures in the insurance company, so using the existing kind of product approval process, or using the existing group IT policy, or using, it's just very, very difficult to do that and to make it work. And so the most successful insurers that have done this have said, okay, we are going to set up a separate business unit. And that can either be separate to us. So it could either be something like the company that I set up, which was called Microinsurance. So that's a separate business unit, or it could be a business unit inside our own business, but that business would be allowed to work to different rules. And it's interesting because that lesson is now starting to happen in developed markets, where insurers are realizing that they need to set up kind of separate innovation departments that actually go after kind of creating new products and new processes. So we've seen that, but we've also seen this, on the product side. We've also seen microinsurance, kind of the learnings from the microinsurance movement, kind of being applied also in the US and in Europe. So, when we set up MIC Global as a reinsurance company, one of the first products that we launched was an insurance that was embedded into a video doorbell that was protecting, parcels that were delivered. So Amazon would come deliver a parcel to your doorstep, and if that was stolen, then you were protected, for a sum of money. And this was a parametric product, and it was, for a very short duration of time, for a few hours, whilst the parcel was on your doorstep. So in this case, we were taking the principles of microinsurance, very simple product, a very frictionless customer journey. And instead of it being for low-income people, we were using short distance or short duration. So usage-based insurance, people, riding or hiring a car or a scooter for a short period of time, or food delivery, right? Your food is late, your food is free, is a great example of a microinsurance policy in a developed market, or these kind of IoT devices with insurance embedded in. So microinsurance is starting to crop up in developed markets now, both from how insurance companies are being structured around innovation, but also about how products are being designed.
Sure. There's actually one thing, and we might as well get that out of the way right now. The one thing that I would like to hear your opinion about, which is the fact that you can do it, so that you can embed an insurance product in a doorbell or video doorbell, and you can protect the value of a parcel and so on. The fact that you can do it, is this a classical case of a solution in search of a problem, or is there actually a need for these type of or similar type of insurance products, or short duration, small value, or small scope type products in developing countries, or sorry, in industrialized countries, or in countries with traditional high insurance penetration?
Yeah. Interesting question. Well, look, so my observation is that insurance, over the course that I've been involved in insurance and reinsurance, which is now, coming up for 26, 27 years, has been that even in that relatively short period of time, there's been quite a move in the insurance industry away from the kind of day-to-day risks that affect individuals, more towards catastrophes, right? So the insurance industry seems, at least, I'm making a generalization here, but in general, the insurance industry seems to be moving more towards kind of catastrophic events, and being comfortable in covering catastrophic events, and trying to convince individuals and businesses to deploy kind of risk mitigation strategies to take care of day-to-day risks. And I think this is one of the reasons why insurance is becoming kind of less and less relevant in people's lives, right? Because, most of us don't experience a catastrophe, in any one year, or even any 10 years, maybe not even in our whole lifetime. If we're lucky, we never experience a catastrophe, and therefore we never really experience the benefit of insurance. And I think what microinsurance is doing is saying, okay, why don't we take care of the day-to-day risks, right? Why don't we take care of the parcel that gets stolen from your doorstep? It's not going to spoil your life. It's not going to ruin your life financially, but it is an inconvenience. Or, if your food is late, your food is free. Again, not going to ruin your life, but it makes insurance very relevant. Or what about, if you went on holiday and it rained for a day? It would be really disappointing. But wouldn't it be great if there was just an insurance that you didn't even have to claim for? It just kicked in, and you got a text message saying, "Hey, Niels, sorry that it's raining on your holiday. Here's €200. Take the kids out for a treat." Right? That's making insurance relevant to people in a way which, at the moment, it may not be as so much. So I think some of these principles around microinsurance, is it a solution looking for a problem? Yeah, I take your point, and I think it's a good challenge. But I do think that these are kind of inconveniences that that people face, and it is a business opportunity to put some money in someone's pocket at the time of need, and to change this narrative around how relevant insurance is to society.
Coming back to your experiences in developing countries and the process you went through in order to shape the products and the distribution channels and so on, what would be the critical capabilities of an insurer that anybody who wants to engage in this market, both in developing countries but also in more mature insurance environments, need to master in order to be successful in microinsurance?
Yeah, sure. So, I mean, we've mentioned some of them already to some extent. I mean, I think, you have to have that kind of mindset of how do I simplify the product to the nth degree? How do I remove friction from the customer journey? But also, I think, I mean, microinsurance and in fact, a lot of embedded insurance, more generally, really is dependent upon developing deep and meaningful B2B relationships, because insurance, microinsurance, embedded insurance, digital insurance, all of these things actually overlap, relies upon distribution through other organizations. And one of the things that so over the course of my career, we started off distributing insurance through these kind of microfinance banks initially. And then we had a big breakthrough with the mobile phone companies, where we were embedding insurance into the purchase of airtime for pay-as-you-go customers, and using insurance to change customer behavior. And then with the kind of mobile wallets, and then more recently with the ride-hailing platforms and and food delivery platforms, these became the platforms that we were leveraging. Interestingly, I think one of the key kind of things that I think a lot of people don't really understand is that actually those B2B partnerships are really critical in succeeding when it comes to microinsurance, but also digital and embedded insurance. And there are really what we learned was that there were 4 kind of key characteristics of any kind of B2B partnership for it to be successful. So, the first one for us was that it had to have a large number of customers that used the service. So we were looking for telcos, banks, ride-hailing companies, right? The second thing that we realized was that that these customers had to use the service frequently. And interestingly, what we learned was that frequency of use equates to trust. People trust their mobile phone company because they buy airtime and it works. And so because it works, they trust that brand. And so if that brand says, hey, if you buy this product, if you get sick, I'll give you this money, people have every reason to believe it, because they find that their experience is that brand is trustworthy. The third thing, especially in emerging markets, was removing friction around payments, because people don't have a bank account, they don't have a credit card, and you can't set up a direct debit. So being able to collect money from them on a regular basis became really important. But it's also still true in developed markets, right? Removing friction from collecting premiums is really essential. But the fourth reason was really the most important, and the one which most people, I was surprised to find most people didn't really understand, which is that the partner, so whether it's the bank, the telco, whatever, they need to have a problem, a business problem. So things like, how do I attract more customers? How do I retain customers? How do I make more money from the customer? How do I attract staff? How do I retain staff? These are business problems. This isn't, and so what we discovered was that telcos and banks, they don't wake up wanting to sell insurance. And and I think a lot of insurance companies forget that, right? And what they wake up doing is they want to be better telcos, better banks, better ride-hailing platforms. They want to make more money. And so if you can position what you're doing to be aligned with their objective, what we found was that we really had a successful partnership, and we were much more successful as a result. And so we got really good at trying to understand what those problems were and how we could use insurance to solve it. So, with the telcos, we were using insurance to, attract more customers, get those customers to stay with the telco longer, get them to spend more money with the telco. And then the telco was willing to push the product as one of its own core products, and that became critical. So I think that that's true. That's very true as a requirement in microinsurance, but interestingly, I think it's also true in developed markets for embedded digital insurance.
So, as mentioned earlier, my my approach to this, the way I like to solve problems, is obviously by the use of technology. And what I hear you say is that there's a substantial integration element in establishing these relationships with your distribution partners, and you
Yeah, well,
somehow need
yeah,
to solve that.
yeah, totally. I mean, Niels, I mean, like, so where technology comes in. So in some ways, I mean, technology becomes a bit of a threshold issue. It's like, you don't show up to the gunfight unless you've got technology. Okay. Yeah. So, and the reason for it is because, technology is critical in removing friction from the customer journey, right? So, our breakthrough with that telco, for example, in India was really simple. Was that we were trying to get people to sign up for insurance using a USSD menu. So this is like, you send a text message and then press 1 to enter your name, and then you have to enter your name, and then press 2 to enter your age, and you have to enter your age. And what we discovered was that people basically couldn't be bothered to answer 3 questions. They couldn't be bothered to answer what's your name, what's your age, and what's your next of kin. And we were losing about 20 to 30% of potential customers at every time we asked one of those questions. We were losing about 20 to 30% of potential customers. And so we started to ask the radical questions, which is, do we actually need to know their name? Do we need to know their age? Do we need to know who is their next of kin? And where we got to was, eventually we got to a point where we radically changed the product so that all we needed was the guy's mobile phone number. So if you just sent literally a text message to a short code, that was it. We didn't have to ask, what's your name, what's your age, what's your next of kin. But in order to do that, we had to have technology that was integrated with the telco, fully integrated. And that's where we had the breakthrough. When we made that change, the very next day, we were getting like 1 million people a day sign up. And it
Yeah,
was entirely because technology had removed the friction.
yeah. I would actually like to turn the table in that discussion for a second, and again, looking at a industrialized world, and if you are a potential distribution partner with the 4 characteristics that you just previously mentioned, then you suddenly become extremely attractive for an insurance company to team up with, because you have a large customer base who interact with you frequently, and so on and so on. And maybe you have a need to supplement your existing product portfolio with insurance type products. So you're very attractive, but you're not only attractive to one insurance company, obviously you're attractive to all insurance companies. So
Right.
so you have a good bargain point in that way. So what do you do if you are an insurance company and you're desperately looking for a partner to fuel your growth, and you have identified, as have everybody else, a certain distribution partner as the obvious partner to you? So now you
Yeah.
need to make yourself attractive. Now you need to
Yeah.
have a proposition to the distribution partner that tops everybody else. So
Yeah.
what kind of gun should you bring to the gunfight?
So, and this is, I think it's a fantastic question, Niels. So, and it's exactly the right question to ask. What I found really interesting as a little incy bincy insurtech. I mean, let's be honest. Microinsure. Probably many people on the call today may not have ever heard of that company yet. Yet it went on to take on some of the world's largest insurance companies and win. Right? We went, and many of the kind of RFPs. We went up against, telcos, banks who were looking for an insurance partner, and we were beating, world-class, multinational, some of the biggest brands in insurance. How did we do that? Well, my experience, when an insurance company goes to, I mean, insurance companies aren't stupid. They understand. They look at, they look at the landscape and say, hey, I'd love to work with that bank or that telco, and they go and they're constantly there. They've got, some of their team constantly embedded into that telco. But the waiting room is full of people from every insurance company. And what they're doing is they're selling insurance. They're sitting there saying, hey, we've got the best insurance. If ever you go and listen to an insurance company make a pitch, they all kind of sound the same, right? And it's kind of interesting. It's like, we're the best insurance company. We've got the best brand. We've got the best balance sheet. Look at all of our clients. And by the way, here are our products. And so most of those pitches end up with, here's our product. And the insurance industry is very, very product led, even to this day, right? And that's why actuaries, so it's a very product led industry. And when you start taking that kind of an approach to a telco, you become commoditized. What happens is that the telco turns around and says, okay, I'm just going to compare the products, right? And I'm going to play insurance company one against insurance company two, and I'm just going to keep playing them against each other to get to the lowest possible price, the best deal for me. What we did was we went in there and we didn't say we were selling insurance. We could have been selling lipstick or McDonald's vouchers or cinema vouchers. We happened to be selling insurance. What we went in and we said, hey, we can move the metrics that matter to you. So we can actually, we can get you more customers who stay with you longer and spend more money. And we didn't mention insurance. And so we were then being compared with all the alternatives. So we weren't being compared with other insurance companies. We were being compared with, okay, should I sell, should I sell this product, right? Should I sell video doorbells, or And so we were being compared with all the possible things that the telco could do, and we had to win that argument, right? We had to win the argument of that, we could move the needle on those things that mattered, but we weren't being compared with the other insurance companies. So by focusing on the problem and not trying to sell insurance and not being sensitive about whose brand it was. So a lot of the insurance companies insist that the insurance product has their brand on it. And that just doesn't work, right? You have to use the telco's brand, telco's brand powered by, and in the bottom corner, the insurance company's brand. And those things are very hard for an insurance company to accept, right? Moving away from being product led, accepting that their brand isn't that relevant, to the consumer. These are big challenges that the insurance company has to get their heads around.
So actually, I think in more traditional insurance products, insurance situations, actually perhaps the brand does make a difference, because people who, if your house burned down, if your car is totaled, major situation like that, you actually would like to know that there's a reputable insurance company behind them, that there's some finances available, there's a practical setup to help you, all those kind of things. But since these covers are different, you don't have the same need to identify your safety, your security with a reputable brand, which might lead you to the conclusion that the brand matters less.
Yeah, kind of. I do agree with you that there is an argument that says that the brand of the insurance company can be important. So I'm not saying it's not important at all, but I would challenge you a little bit. In the UK, 10 years ago, people bought insurance from agents and directly from insurance companies. Nowadays, I don't know the exact statistic, but the majority, nearly all people buy insurance from 3 price comparison websites. And in many cases, interestingly, when people are stopped and asked by the police, hey, do you have insurance? Yes, I do. And they use the name of the price comparison. They say Money Supermarket or Compare the Market, right? They don't even know what is the name of the insurance company. In fact, they don't care. And in many cases, after your house in the UK, the car is the second biggest asset that people own, and it's certainly the second most expensive thing on their budget, right? So they don't even know what insurance company they use. So I think it is important, but I don't think it's as important as people imagine. And I think that certainly there are brands like people's banks, their telcos, even the food delivery company, which are much more trusted than that of the insurance companies. And this is because, if you think about insurance, we interact with the insurance company once a year, right? We pay our premium at renewal, we pay our premium. And if we're unlucky, we have another interaction, which is a claim, right? But many of us don't make a claim every year. Maybe every 5-10 years, you might be unlucky, you have to make a claim. So we don't have very many interactions with our insurance company, and this is why the insurance company apps don't really work, because you forget the password, or the website, you forget the password by the time you have to go around and renew your insurance policy. So I don't know that the brand is really that important to people. In some instances, it is. I agree with you, but in many instances, I think you'd be surprised how people aren't that sensitive to the brand of the insurance company.
Yeah. Actually, I would like to get back to a point you made just a moment ago about the importance of making the interaction with the customer frictionless, seamless, and you especially highlighted the need of asking fewer questions, very few questions. Considering this in a risk assessment context, so now we're going to underwrite the late delivery of food or the risk of theft of a package placed at your doorstep, stuff like that. So first of all, where do you turn to for risk analysis, for details, data about the actual risk? And what can you potentially supplement the habit of asking a lot of questions with something else that helps you assess that risk a bit better?
Yeah. So look, I mean, certainly, I think that there are some kinds of insurances where you do need a lot of data, right? So when I buy life insurance for a million euros, it's kind of like it's expected that there should be a bunch of questions, right? Tell us about you, tell us about your health, tell us about whatever, right? And all of that information needs to go into an individual underwriting decision, right? Because if I'm buying a million euros of life insurance, then absolutely, then there's an expectation. And actually, I would expect to answer those questions because it's a big purchase, and it's worthwhile, therefore, filling out the form or answering the questions, however that might be done. But when it comes to, when it comes to like the food on the back of a bike being delivered to you, I mean, you don't want to answer any of those questions, right? So a lot of these kind of small ticket, short duration insurance products that are embedded or digital or micro, actually people aren't going to answer any of those questions, right? So, and actually, I would answer they don't really need to because there isn't any actual individual underwriting. These are group policies, right? Where it's a one size fits all. It's a baseball cap of insurance. One size fits all, and the sum insured is not very big, and therefore what you're doing is you're actually just you're flipping the coin, right? A million times, and as a result, you're using kind of the law of large numbers to understand and price these products. Now, the other attraction of these small, short duration policies, because most of what goes on in micro, in digital, in embedded, these policies you can have them so that they're no more than 30 days long. Some of them are 15 minutes long, right? Some of them are 3 hours, but very few of them need to be longer than 30 days because you can tie it into the payment of premium. So you can make the premium, you pay the premium in March for coverage in April. You pay in April for coverage in May. And what that allows you to do is to introduce the repricing of the product, right? So your ability to underwrite the product becomes linked into the nature of the product, whereby you say, okay, so I'm going to actually target a loss ratio of between X and Y, 40%, 60%, whatever the loss ratio is that you want to target. And every 30 days, I get the ability to reprice the product because I'm getting data about real-time data about claims and premiums, and therefore I can reprice the product. Take the example of food on the back of a bicycle. You actually get data every 15 minutes about whether or not and so then the role of insurance is to smooth out the peaks and troughs, right? So I think embedded digital micro, if you want to be successful, you've got to substitute asking for a lot of data up front with the ability to change the pricing on the back end. And that's how you go about underwriting those products. It's a very different philosophy. And if you insist upon asking for information, then you will probably fail because no one is going to give you that information for a 15-minute or a 30-day policy. It's just, it's a one click or a one text message or a press one for this policy, right? And in fact, the smartest people, the smartest companies are getting their data from the partnerships. So imagine a situation where, you get into your car, it's got a sat nav, if you're really smart, and if you were, if you had a relationship with Mastercard, you could, for example, you could have seen that, hey, Niels bought a ferry ticket from Amsterdam to somewhere in Spain. So okay, we know that he bought that ticket and it's going to be leaving on Friday lunchtime. So they could work out that actually at 9 o'clock in the morning, why not send you an offer saying, hey Niels, would you like to have breakdown insurance for 1 week for your trip to Spain? Press 1 for yes. They've got the data, right? They've got the information, and they've got all of your billing information, and they've got your card. Just press 1. And so,
Yeah.
that's how simple things have to get to if you're going to be successful with
Yeah.
these kind of business models.
We actually did an analysis some time back on price comparison sites that you mentioned as being the main source of insurance, especially in the UK. And one of the critical capabilities that we identified as something you have to master is not only the ability to do more or less real-time analysis of your risk intake or of the claims scenarios, but also having the ability to actually make price changes to your risks. Because if something happens, if you need to increase your premium, or even you have to be more competitive and lower your premium, one thing is to know that, but another thing is actually to be able to react to it, to make the changes that you do. And of course, especially when it comes to risk analysis. And we already had a question in the chat. Where are we on AI in terms of analysis?
Well, I think AI is being used in some of these products. So, for example, machine, but it's mostly kind of at the moment around kind of machine learning, right? In my experience. So, for example, one use is that imagine that you've got an app, a parking app, right? And the parking app, people in certain Asian countries, it can be very difficult to find a parking spot, and so the parking app is used by people to find a parking space. It will tell you if you go to this car park, then there's 10 spaces on level 4, and so people use these apps. But then, of course, they then use the app to find the parking space, but then they also can pay for the parking space in the app. And one of the things that's happening is that people are starting to embed then insurance, not for the car, but for the deductible. So most car insurance has a $200 deductible, and what the insurance is for like any little dents or scratches that you might pick up whilst your car is parked. So when you download the app, or you're asked as a user of the app, would you like to have this add-on insurance that protects you for dents and scratches? And in order to buy the insurance, so if you click yes, then it prompts you to do a kind of walk around, take pictures or a video, one time around your car, and then that's it, right? And then every time you park, you pay for the parking, but you also pay a small premium for the dent and scratch insurance. And if you want to make a claim, you take a photograph of the scratch. It compares, machine learning can compare the video or the picture originally with the new picture, and if there's a scratch, then there's a payment's just made, a couple of $100, and the guy can go and get someone to mend the scratch. So that's one way that AI is being used. But I mean, also, for example, in that doorbell insurance, right? So it's parametric. So if the package is left on the doorstep, you have to be then integrated into the data feed from the video doorbell, and so the insurance starts when the parcel's delivered. Well, there isn't someone sitting watching the video, right? It's AI. So, the policy starts when the parcel's delivered, and a claim is automatically triggered if it's stolen. So the AI has to recognize that someone came, took a parcel, and didn't open the door, right? That's the definition of kind of it being stolen. And in many cases, the householder gets a text message saying, hey, Niels, sorry, your parcel was delivered, but it's been stolen. We've credited your account with 50 euros. So the guy hasn't even got home yet. He hasn't even made a claim, right? So he doesn't even know that the parcel was delivered, let alone that it was stolen. So AI can be really powerful in giving those fantastic kind of customer experiences.
Yeah.
But it's really on the claim side, I think, at the moment, more so than on the underwriting side.
So
Niels,
yeah,
just one thing to previous to that question. I think that there is one interesting thing which is going on, which I'd love to to talk to you about in the insurtech space, which I've seen kind of play out in emerging markets, but also I think it's starting to play out in developed markets, which is really about this drive towards profitability. So, I think over the course of the last few years, a lot of investors have moved from a drive towards growth towards a more of a metric of a drive towards profitability. And I think one of the things that we saw in the microinsurance space was that a lot of the insurtech started off as a broker, right? And so what they were doing was, certainly Microinsure, for example, was a broker. We were designing insurance products, we were selling the insurance, we were collecting the premiums, we were handling claims, we were doing a lot of the operational stuff, but we were being paid as a broker. And it was really hard to get to a position of profitability. And so we had to become the balance sheet. We had to become the reinsurance company or the insurance company. And I think we're seeing the same thing play out in developed market as well, where a lot of the insurtechs, as insurtech as an industry evolves, everyone starts off as a broker because it's it's the lowest barrier to entry, it's the lowest capital requirement, it's the lowest regulatory requirement, it's the quickest model to get up and running. And what you do is you get into a market, you prove what you can do, you create a client base, you create a new opportunity, but then you need to actually monetize that and you need to become profitable. And I think there's a huge move around insurtechs as they mature and get to scale and need to move towards profitability, becoming the balance sheet. And I think we're going to see more and more of this. And it's something which happened for us in Microinsure. We realized it probably 10 years ago. And it's interesting now that you're seeing this happen as well here in developed markets.
And I think another aspect of that is the importance and the need to be able to apply other mechanisms for customer service, customer retention, growth than price. So you have seen time after time that a new player enters the industry, underbids everybody, competes exclusively on price, gains 10% of the market, and we certainly see that in Denmark a couple of times, gains 10% of the market by attracting the relatively unattractive risks by underbidding the market, and then leaves after a couple of years because it's just hugely unprofitable to do that. And even large insurance companies, so that I worked with a Danish insurer who actually had developed, talking about AI, they actually developed a relatively sophisticated AI-based model that was able to predict customer churn. So they knew actually in advance, more or less, who was going to leave them in a month's time. But the problem was that the only vehicle they had, the only mechanism they had to keep customers was to offer discounts. So in that way, they eroded their own profitability in the attempt to keep customers instead of having other ways of attracting customers and to keep existing customers. And I think that has led to the whole discussion about ecosystems, that you team up with somebody else who have a supplementary offering that you can throw at the customer.
Right. Totally. And this is, that the discussion that we had earlier about brand, right? I think that actually is a really interesting point, because basically what you're saying is that the brand of the insurance company wasn't that important in keeping the customer. It was really just a commoditized price-led discussion, right? Whereas if that product and that insurance company had been embedded into another good or service, like a bank account, it's a lot more difficult. It's a lot more painful to move bank accounts, and you're not going to move bank accounts just because you can get a slightly cheaper insurance somewhere, like on another bank account, right? So do you see my point? It's like sometimes embedding your product in with another good or service which people value or provide stickiness can be very, very smart in terms of like moving away from a kind of pure price commoditization. Yeah, and we've seen that in our markets.
So Richard, you mentioned that you have been competing and won against some of the large, reputable insurance companies in the world. But let's put ourselves in their position. Let's say that you are one of the largest players in your home country, in the domestic industry that you're in. You are looking at a market with very little gross written premium growth, a stable economy, high insurance penetration, yet you still have some investors behind you who would like to see you grow your premium. And you have, based on our discussion today, you agree microinsurance could be the source of growth that you're looking for. What do you do? How do you get started on this?
Yeah, I mean, it's true. Look, I mean, if you look around globally, it's true that, insurance isn't even keeping up with the growth in GDP, right? So, not picking out any insurance company, but as an industry, we are not keeping up with growth in the economy. The economy is growing faster than we are as an industry. So, therefore, we're effectively shrinking in size and relevance. Um, I think that there isn't enough innovation happening around the new risks that are facing. Risks are changing. The risks that we face are changing in number, in scope, in frequency. And I'm talking climate change. I'm talking about, digital, the digital environment, digital disinformation. I'm talking about like health and wellness. I'm talking, so the risks that we face are changing. And I don't see the insurance industry keeping up with that. And I think, there's a need for innovation in those spaces. And I think that, I do actually firmly believe, right? I do firmly believe that the insurance industry is best placed to address those risks. So I do think that the insurance industry is completely relevant and is the best mechanism that we have to address those risks that society faces. But there seems to be a bit of a breakdown in innovating and taking that leap of faith and creating the products, the services around those new risks. And so someone has to do that. Someone has to get those things up and running, and then eventually they need to be kind of mainstreamed into the insurance industry, because the insurance industry is best placed to massify, to scale those kind of new things, but not necessarily the right place to start to innovate. And that's certainly something I'm turning my attention to now. With my new hat on, it's something that I'm passionate about, and building a team to kind of go after those new opportunities.
So I think you mentioned that, but let's just repeat it so everybody, so we ensure that everybody got the message. But I think you mentioned that it's very difficult for an established insurer with long tradition, long history to be innovative in their own right. Is it necessary to put innovation teams out in arm's length to allow them the independence, the flexibility to do whatever they want in order to be innovative if you are a large insurer already?
Well, look, I mean, a number of the large insurers I work with, they might have things like, they won't put products through their product development process unless there's a guaranteed $10 million of gross written premium in the first year. Very, very difficult to do that when a product doesn't exist and has never been launched before. You can't say for sure that it's going to generate $10 million in its first year. Many insurers I work with, their product approval process takes a year, takes 12 months. And one of the reasons it takes 12 months is because they need to go through all of the data. Well, many of these risks, there is no data, right? There is no like historical data showing what the claims is going to be. So it's very hard to work within the existing approval process for a product in a big insurance company. And I think many big insurance companies would be the first to admit that. And they have admitted that to me. So they either need to outsource that, or they need to put that into a different vehicle internally or externally, which doesn't have to play by or comply with those rules. I'm not saying that we should ignore prudent, business rules. I'm not saying that in any way. I'm just saying that, we are not, as an industry, going to innovate if we continue to insist that all innovative projects, have to kind of like meet all the requirements of an established product like a motor insurance or a life insurance. It's not going to happen. So we have to find a different way of doing it.
And I think actually the whole concept of the InsurTech industry was really an effect of the idea to outsource innovation. And I have to admit that the jury is probably still out, but I'm not sure that we have seen that the premium paid by insurers to sort of buy back the innovation. So you mentioned the idea of outsourcing innovation, allowing somebody to grow a business and then sell it off, or for the insurance industry point of view, buying it back. That the premium we have seen paid for InsurTech companies probably doesn't justify the volume of business or even the profitability that we have seen. So it's a model, but it's a very expensive model.
Yeah, I think, the mistake that I think we all made in the insurtech, if you go back 10 years, a lot of the narrative around insurtech was, hey, we're insurtech, we're going to kill off the insurance companies. I mean that you heard that. I mean, if you go back and look at articles, look at news, that was very much the narrative. Hey, we're here, we're the guys that are going to rescue the insurance industry. I think that was very arrogant and wrong. And that's changed to, hey, how do we partner with you? And I think now there's this new chapter, which is kind of how do we work together in partnership and recognize that the insurtech, is not going to replace the insurance industry. It's never going to happen. But perhaps the insurance tech industry is well placed in addressing some of these innovations and working in partnership in lockstep with the existing insurance industry. So that the innovation is done in the early days by the insurtechs, and then the insurance companies almost have a kind of pre-agreed contract that if those companies hit certain milestones, then they'll be purchased at a set price. So it's almost like building innovative companies that the insurance industry want to buy, but at a pre-agreed price. And some of those models are starting to come through, and I think that's the way that we'll end up going.
Sure. So coming back to the discussion we had on critical capabilities, and again, putting ourselves in the shoes of the existing insurance industry, who's looking and is prepared to make an investment in building those capabilities in order to engage in the microinsurance market. And you already mentioned that the ability to integrate to distribution partners, ecosystem, to have that technology capability to integrate, that's quite key. Also, you mentioned that the ability to analyze data coming in. So you mentioned the short-term policies, 30 days policies, or continuously reanalyze the risk that you have assumed and make price adjustments to that. That's also very important. What other capabilities should you invest in as you're building your microinsurance hard-hitting team?
Yeah, sure. So, I mean, and first off, I mean, it's a bit of a shameless plug for guys like you, but I'm a big believer that those kind of technology, the technology that you need to integrate, to do the data analytics, etc., it's always best just to outsource that, right? I mean, I started off building it ourselves. Now the companies that I'm now involved with creating, I'm outsourcing it. It's just much more efficient to do that to someone who just specializes in building those platforms. So I'm very much, I've swung from the kind of build to buy kind of mindset in terms of tech in the startups that I'm now involved in helping create. I think though that the other critical component is really, and I'm going to go to my deathbed, I'm sure, being famous for this. It's distribution, right? So it always amazes me that people, as an industry, we're so product led. We imagine that if we build it, that people will come. And it's just not the case. No one wakes up wanting to buy insurance. And the partners that we work with have many other choices for what they could use to make themselves better banks and better telcos. So you need to invest in people who understand how to approach and lock in these critical B2B partnerships, which are so essential when you initially go to market with a new innovative product idea. Most product ideas that go to market are not B2C, ideas. They initially start off as B2B, then they might become B2B2C, and eventually they might become B2C, which is fantastic. But you have to start with a B2B model. And therefore, in order to succeed, you need to understand how to create how to create those partnerships, but also how to make those partnerships really productive, right? Too many organizations think, okay, once I've onboarded that bank or that telco, that's it, job done. Let's move on to the next one. That's just the starting gun, right? Like you've then got to actually, so there's hunting and there's farming, right? You've got to hunt those new opportunities and you've actually got to farm them to make them productive. And all too often, organizations do not understand that the business development of new partnerships and account management of existing partnerships are perhaps the most critical components that they need to invest in.
And if distribution is so key to success, and considering that for the last many years, decades actually, we've seen an influx of new capital to the insurance industry because a lot of investors have seen that there's a higher than average return on investments in the insurance industry than elsewhere. Would you think that traditional distributors such as Amazon, eBay would have a head start on everybody else and should actually bypass the insurance industry and engage directly, or are they actually better off teaming up with existing insurers to deliver those extra products to their customers?
Yeah, I mean, it's the perennial question, isn't it? Right? I think if we're being honest, if Google or Amazon or any one of those guys decided to get into insurance, I think that a lot of insurance companies would go bust. Frankly, because they just have they have a huge brand recognition. They're trusted by millions and millions of people. They've got a lot of information. They've got the data that would enable them to offer really tailored products and solutions to people depending on they know that you have a cat, that you like surfing, whatever it is, and they would be able to tailor kind of products to you in a way that we could only dream of as an insurance industry. I think the question is why haven't they? I mean, we've all been talking about it for a long time. I think there's a number of reasons around it, but I think the regulation probably puts them off. The uncertainty, they just don't want any kind of backlash or problem. So they've ended up being marketplaces as opposed to taking on the ownership of the balance sheet. And I think also, frankly, they see that there's better returns from the effort that they could put into other kinds of business ideas. So insurance, frankly, yes, it is an attractive business model, but it's not as attractive as perhaps some of the others that are competing for their time and attention. And that's been the saving grace for the insurance industry. I think as a result, that leaves the door open for us as an existing insurance industry to try and work with those organizations. But we can't go to them and say, oh, we're an insurance company, will you work with us? It just doesn't work like that.
Yeah.
Or if it was going to work like that, it would have worked by that. Believe me, every insurance company in the world is knocking on Amazon's door every day of the week. So if it was going to work, it would have worked. And it really has.
There is this famous example of Google doing some early exploration of the insurance industry some years back until they realized that they actually made more money off taking money from the insurance company, allowing them to do advertising on Google than they potentially could make by engaging in the insurance industry. So
exactly right. So then what they do is they sell adverts and they sell rack space, or whatever and that's the same with AWS, right? Like Amazon make more money off of hosting data centers than they do by from the kind of 95% combined ratio that would result from insurance.
Yeah. So, Richard, this has certainly been a super interesting discussion. I hope that the people who have been following this online or will be watching the podcast coming out of this will find this inspirational as well. I would like to encourage everybody actually to reach out to Richard, and I hope it will be fine if they connect with you on LinkedIn or to myself. Sure. You recently announced that you just had a new job, Richard, so maybe you can share what you're going to do going forward.
Yeah, so I'm doing many things. I'm self-employed, but one of the big things that I'm going to be doing is working with a team at Arc Venture Studios. So Arc Venture Studios is going to build and own ventures that are addressing the systemic risks that face humanity. So we're very focused on risks such as digital disinformation, health and wellness, poverty traps, climate. And we're working interestingly with a lot of the large insurance companies, but also, industries like the pharmaceutical industry and kind of DFIs like the World Bank, etc., to really go downstream and create these kind of innovative insurance companies, which eventually we intend to sell into the mainstream insurers. So that those ideas, once they're proven, once we've got lost data, once we've shown that this is a viable, profitable line of business, that we're then going to sell to the insurance industry for them to take to scale. And as Arc, we're going to combine a range of things like the ability to kind of identify those problem spaces. We're going to have a small team and a small fund to be able to initially pay for the creation of those kind of pre-seed and seed ventures. And then we're also going to try and deploy capital to underwrite those products as well. So it's an exciting time, and we've just launched our first 4 ventures as ARC, and we hope to do eventually to launch about up to 20 new companies a year. So it's going to be an interesting time.
Fantastic, and best of luck to you with that. And again, thank you very much for joining us this morning. I really appreciate you sharing the insights you have had in the microinsurance industry through many years. Thanks to everybody joining, and looking forward to engage with you on a different channel. Thank you very much. Bye.
Thanks.